Hi everyone, let's take a look at exercise 11-2, which deals with adjusting entries relating to liabilities. And you'll have to bear with my voice. I have a bit of laryngitis and a cold, so I will sound a little bit different than I normally do. Okay, let's prepare the necessary adjusting entries at December 31st, 2005 for Yacht Company's year-end financial statements. And we have 6 different transactions to consider. Let's take a look at transaction 1 first. During December, Yacht Company sold 3,000 units of a product that carries a 60-day warranty. December sales for this product were $120,000. The company expects 8% of the units to need warranty repairs, and it estimates that the average repair cost will be $15. Okay, and let me just scroll up so you can see the solution to part 1. Okay, so in terms of the math, we have to come up with a debit to warranty expense and a credit to an estimated warranty liability account. You could call it estimated warranty liability. I've also seen it simply called warranty obligations or just warranties. Okay, now how do we calculate it? We take the 3,000 units times the 8% expectation for the number of units that will require a warranty repair, and then we multiply it times the average repair cost. So certainly in this first transaction we're showing an estimated liability and how we record that on the books at the end of the year. Okay, let me slide back down and let's read number 2. A disgruntled employee is suing the company. Legal advisors believe that the company will probably need to pay damages, but they can't determine the dollar amount. Okay, well, for number 2, the answer appears in front of you. There's no adjusting entry that can be made because the loss cannot be reasonably estimated. This falls into the classification of being a contingent liability, and it should be reflected in the notes to the financial statements, and that assumes that the liability is material. If it's immaterial, which means it's a relatively small lawsuit, it won't even appear in the notes. Let's look at number 3. Employees earn vacation pay at a rate of 1 day per month. During December, 20 employees qualify for 1 vacation day each, and the average daily wage is $120. Okay, well from that we know we're going to multiply the 20 employees times 1 vacation day times $120. We'll debit an account called vacation benefits expense. Okay, there it is in front of you for $2,400. Okay, I've also simply seen this called vacation expense, and in some companies they don't even separate the vacation, they just lump this into salaries and wages. Okay, and how did we come up with the $2,400 amount? We took the $120 times 1 day times 20 employees. And the liability we record is vacation benefits payable. Again, the whole purpose of this entry is essentially the matching principle to make sure we've stated the liabilities correctly and we've recorded the expenses that relate to the accounting period for which we're making adjusting entries. Okay, let's look at number 4. Yacht Company guarantees $5,000 debt of a supplier. The supplier probably won't default on the note. Okay, what do we do here? Well, we don't record any adjusting entry. Since it's not probable that the supplier will default, there's nothing to record. Now the guarantor, Yacht Company, should describe the guarantee in its financial statement notes as a contingent liability. Again, I want to make the point that only if it's material. If this amount is immaterial in regards to the financial statements taken as a whole, it won't even appear in the financial statements. Okay, let's tackle number 5. Yacht Company records an adjusting entry for $2 million of its previously unrecorded cash sales, and those cost $1 million, and its sales tax rate is 5%. Okay, so what we're doing on number 5 is we're going to record the sales and the sales tax. So the cash amount that we receive is actually the sum of the sales that we recorded, the $2 million, and they've told us it's unrecorded, so we need to make sure we get that recorded. And 5% of the million cost relates to sales tax, right? I'm sorry. 5% of the $2 million represents the sales tax, and we need to record that as a liability. When we sum the two, we get cash. Now, the $1 million we are recording as a debit to cost of goods sold and a credit to merchandise inventory. So we're assuming we are operating a perpetual inventory system, and that's a pretty good assumption since most companies these days aren't using a periodic inventory system. They'll be using a perpetual inventory system. So we record the sales and we make sure we get the cost of the sales recorded in the same accounting period. Now let's look at number 6. The company earned $40,000 of $100,000 previously received in advance for services. This is merely an adjusting entry. We want to reduce our unearned services revenue liability by debiting it for $40,000. And we will credit the services revenue. In this case, they're calling it the earned services revenue, but I've also seen this simply called services revenue, and that appears as an income statement account and will flow through to the income statement. And we would properly note this as to record product revenue earned. Okay, that takes care of 11-2, everyone. I hope you've found these explanations beneficial.